Hey everyone, welcome back to Monkeynomics, and today we're going to be talking about alternative investments. Now, I didn't touch on this in my original investment series because alternative investments are usually restricted, and a qualified investor is someone who has $1 million in net worth minus their primary residence, so you can't count the value of your primary residence in your net worth, or you have to make $250,000 a year at your job or whatever. So most people don't fall into that category. So most people don't qualify for most alternative investments. The other problem with alternative investments is they're usually very illiquid, which means you can't pull your money out for usually a number of years, sometimes 5 to 10 years. And they usually have very high minimum investments, sometimes in the tens of thousands or hundreds of thousands of dollars. This means that if you're just the average Joe investor, and you only have a couple $100,000 in your entire investable accounts, you put all of it in one or two investments, you're not diversified. All your money's in one basket. So if that one investment goes south, you're bankrupt. So to prevent that, some states, including New Jersey and Massachusetts, have restricted the amount you can put into alternative investments, capped at 10% of your portfolio. So this means that if you want to invest in alternatives, you can only put up to 10% of your total portfolio in alternatives. Now, the reason why alternatives are popular is because they can provide a, you guessed it, alternative to traditional things like stocks and bonds and so forth. So while I don't think this information or advice is applicable to most of my viewers, there are a small handful of you who have reached out to me regarding my investment stuff, who want to know about some of these alternative investments, so I'm going to tell you my thoughts and feelings on these issues. Now, there are a few classes of alternative investments which I won't be talking about because I just simply don't know enough about them. I don't deal with them, I don't feel I'm qualified enough to speak on them, and those would be things like private equity, venture capital, collectibles, stuff like that. So if you're looking to invest in a startup, kind of like Kickstarter or angel investing, you could do that. I don't know enough about that to advise you or say whether it's good or bad. I would say that if you're going to invest in a startup, you better know damn sure that that startup's got places to go and is going to give you a return on your investment. I would also caution you not to invest in family members or friends. Nothing will destroy the relationship quicker than mixing money into the equation. So stay away from investing, quote unquote, with friends and family, unless you're just going to give them the money. Don't expect to get a return on your investment because you're probably not going to. And if you expect a return on your investment, if you actually do invest in friends and family, expecting this to be a valid position in your retirement portfolio, you're going to destroy your relationship when that doesn't perform. So don't do it. But the classes of alternative which I do know enough about to speak on are going to be hedge funds, private REITs, real estate limited partnerships, oil and gas partnerships, and natural resources. So first off, let's talk about hedge funds. A lot of people don't know what a hedge fund is. They know what the word is. They hear the word thrown around a lot, and it seems really mysterious, like what do these hedge fund managers do? What a hedge fund does is it invests other people's money as if it were their own. If you're a fund manager of a mutual fund, you're very restricted about what you can do with that money because it has to be redeemable at any time. You're not allowed to basically take long positions because someone could redeem the shares of their mutual fund anytime they want. You're also restricted to what the purpose of the fund is. Like if you're the fund manager of a large cap growth fund, you can only invest in companies that are in the large cap growth sector. Whereas a hedge fund manager usually has more discretion over what he does with the money. It can also declare that the shares in the hedge fund are not redeemable until a certain time. For example, let's say January or sometime at the end of the quarter or end of the year. That will be the only time you can actually cash out and redeem your position in the hedge fund. So this gives the hedge fund manager more discretion about what he can do with the money. A lot of people turn to hedge fund managers in environments where it's difficult to make money. They do this primarily through leverage. Now, leverage is a fancy word for borrowing money to invest. So you're borrowing people's money, paying interest on that money, and then investing that money, and you have to get a return higher than the interest you're paying for the money in order to create a return for yourself and for your clients. This is when you get into stock options like calls, puts, straddles, and so forth. Now, the good thing about stock options is it can create movement in a flat economy. If the market isn't moving up or down, it's just flat, you can use leverage and stock options to create some movement so you can actually make some kind of profit. I do not recommend you get into stock options unless you know what you're doing, because this is where you can actually go bankrupt. Now, if you invest in something terrible, like you bought stock in Circuit City or Blockbuster Video, worst case scenario, your investment becomes worth nothing and you lose all the money you invested. However, nobody's going to come and kick you out of your house and repossess your car because your stock's lost value. However, if you use leverage, if you borrow money to invest it and then those investments go south, then somebody will come and take your car, that someone will kick you out of your house. You actually will go bankrupt. So stay away from leverage unless you really know what you're doing. The only kind of stock option that I like is what's called the covered call, because you really can't lose. And here's how a covered call works. You have a stock that you will sell if it goes up, but otherwise you're just going to hang on to it. Now, normally you wouldn't make any money on this stock unless you sell it. But if you sell a call, you're basically selling the right of someone to buy that stock from you at a certain trigger price. So what you do is you set that call for about 10 to 20% higher than the current market price. So if the value of the stock goes up by 10 or 20%, you'll sell it, which you probably could do anyway, because a 10 or 20% return is fantastic. What you do is you sell a call. Now, if you sell the call and it goes up 20% and the call is exercised, somebody can buy the stock from you at the execution price of the stock option, and then they can sell it for more than 20% if it continues to go up. This means your profits are capped at 20%. However, if the stock doesn't go up 20%, it doesn't actually hit the trigger price, you get to keep the premium you sold the stock option for. So you still made money. So if you don't expect the stock to move, you can sell calls, and then if it goes up, you still made 10 or 20% in addition to the premium, and if it doesn't go up, you still keep the premium. So you win either way, and there's no situation where you lose. Now let's say the stock goes up 30%. Well, you only made 20%. You still didn't lose. You just only made 20%. You could have made 30%, but you only made 20%. So what? You still made 20%. That's amazing. And that is the only kind of stock option that I recommend people do, because you really can't lose. You can buy and sell stock you don't own, which are called naked puts or naked calls. Do not do that because it's based on leverage. You're promising to buy the stock later at the market price, and if you can't afford it, they're going to come repossess your shit. Anyway, returning to hedge funds, they use things like leverage and stock options and long short and stuff like that in order to make money for their clients. However, because there's a lot more active management involved, the hedge fund manager has to be more involved in the day-to-day activity of the fund and the money. He's going to charge a much higher management fee. You know, if you just put your money in an index fund, you're going to pay 15 basis points a year. It's nothing. It's almost free. But when you put your money into a hedge fund, that manager is going to want to get paid because he's putting an extraordinary amount of work and expertise into your money. The problem with hedge funds is even if they do create a lot of value, they usually take most of that value away in the form of their fees. So you gave this hedge fund manager all this money, and they made you money, but then they kept most of it because of the fees they charge, and then in the end, you basically got returns commensurate with if you just put your money in normal stocks and bonds. Really, unless you're going to do things yourself, there's really not a lot of money to be made in investing in hedge funds. In fact, you'll sometimes lose money, because if the hedge fund manager only makes you a slight increase over a traditional investment, and then takes most of that back in fees, you may actually have a net negative, a net loss, because the fees outweighed the value added of his services. So I personally do not recommend investing in any sort of hedge fund, long, short, any sort of these alternative kind of wedges involving hedge fund managers. I just don't believe in it. It doesn't seem to pan out. You're better off just putting your stuff in the regular market. Now, the reason why people like hedge funds is because the hedge fund manager will try to make money in any economy. But you have to factor in the fees. You have to factor in paying for his services. That comes out of your returns. So it's either going to lower your returns or it's going to exacerbate your losses. And at the end of the day, they're very highly compensated and they're often not worth the money. Alright, so a private REIT or a real estate limited partnership are kind of related. Now, I talked about REITs in a previous video, but what a REIT is you're essentially investing in owning a certain property and then the income coming from the mortgage or whatever flows to you. Now, a lot of people don't know this, but let me just briefly explain how mortgages are kind of handed off. When you get a mortgage from a bank, the bank will then sell that mortgage to Fannie Mae or Freddie Mac. So the bank doesn't hold on to the mortgage, because if they did, it would take them 30 years to get that money back in order to lend it again. So the government created Fannie Mae and Freddie Mac to keep the economy going. So Fannie Mae and Freddie Mac buy the mortgages from the banks so the banks can re-loan the money again. But what do Fannie Mae and Freddie Mac do with the mortgages? Well, they carve them up and they sell them as REITs, which are real estate investment trusts. So it allows people to own a piece of real estate, Because real estate it's an alternative investment in that it's not correlated to the stock or bond market. Usually when stocks go down, bonds go up and vice versa. Real estate kind of does its own thing. It's really not that uncorrelated. Because when the economy goes down and stocks go down, people also get kicked out of their homes and stop paying their rent. So they're not completely uncorrelated, but they're less correlated. Anyway, you can buy REITs on the open market. So they're not really an alternative. They're actually more considered in the long-term bond space. But private REITs aren't available on the open market. So again, you have to be a qualified investor usually to invest in these. And so you have a company, it owns a handful of mortgages, and then it's going to share the tenant income with you. It works just like a public REIT. In fact, several private REITs want to eventually go public once they grow enough. But it works similarly to an initial product offering. When a company kind of goes public and wants to be listed on the stock market, the people who own the stock of the company before they went public usually get a huge return on their investment because they got in at the ground floor. So investing in a private REIT that's hoping to go public could be very profitable if it actually successfully goes public. Now, if the real estate market tanks, if your tenants stop paying, if they get evicted, if the businesses that are in the warehouses or in the office buildings go out of business, that's going to hurt your investment. Now, an alternative to a private REIT is a real estate limited partnership. Now, this is what I actually recommend, although most people probably won't be able to qualify for this. But think of it this way. People who do real estate deals for a living, they go in, they buy the real estate when the guy's about to be evicted or crummy neighborhood. They fix up the house, they flip it, they sell it for 3 or 4 times and they paid for it. And they do it in the span of a couple years. Let's say 3 to 5 years. So people do that for a living. That's their job. They buy houses cheap, they put in the sweat equity to bring them up, and then they sell them for a lot more than they paid for them. They keep the money. Now, how would you like to be the silent partner of one of these companies that goes in and does this for a living? You don't have to do any of the work yourself. You're not going in there and actually rebuilding their kitchen or anything like that. You're just putting up the money to help them buy the real estate, fix it up, and then they're going to share the profits with you once they sell it. That is essentially what a real estate limited partnership is. So these companies buy specific pieces of real estate, usually like apartment buildings and stuff like that. They fix them up, maybe get some tenant income in the meantime, and then sell it in about 5 to 10 years, and then they split the profits with all their silent partners. Now, just like with normal real estate investing, you're going to be highly concentrated in a couple properties. So you're not going to get wide diversification like you would with a REIT. But what you will get is you'll get significant returns as long as the real estate pans out. So a lot of these companies that bought real estate 2009, 2010, they made over 10, 15% for their investors, which is crazy. And then most of those deals are dried up now. But that's essentially what the limited partnership provides. What you get is what's called an internal rate of return. So you can calculate that similarly to the returns of a normal investment. However, it's completely illiquid until the actual real estate is sold. Just like if you owned a vacation home. You can't just pull money out of that unless you want to refinance the mortgage. The only way to pull money out of that investment would be to sell the vacation home. So the only way to get your money out of this limited partnership is when they actually sell the assets and the limited partnership is dissolved. So you're looking at about a 7 to 10 year turnaround in order to get your money back. However, if you annualize your returns, you could make somewhere around 10% a year because you're getting in this business that's buying and fixing up and selling real estate. So it's great if you can afford to get in on it. However, you have to have a lot of money to get in on it. Now, oil and gas partnerships seem like they would work similarly, but they really don't. The oil and gas partnership is where you invest in either the drilling or maintenance or whatever, creating the oil well for oil exploration, digging, and extraction. The main advantage of these investments is the tax advantages. Now, you probably hear all the time in the news, especially because it's an election year, how subsidized the oil industry is. Well, the reason why it's subsidized is because we don't want to be completely reliant on Saudi Arabia for our oil. So we have to subsidize the exploration and drilling part of the oil industry, otherwise they're not going to do it, we're going to have oil shortages, we're going to be more dependent on foreign countries. So you could take advantage of these subsidies by investing in an oil and gas partnership. You can use those subsidies to your advantage. So the main people that the oil and gas partnerships appeal to are people who are trying to lower their taxable income, or who want tax-advantaged income in their investments and don't want to invest in municipal bonds. Municipal bonds are usually the go-to when it comes to kind of tax-free or tax-advantaged investing. However, bonds are paying shit right now, absolute shit. So if you need to lower your taxable income but you don't want to make 1% on your money, then the best place to go is an oil and gas partnership. But other than the tax savings, you're not making that much money. We're talking like 3 to 5% a year, and that's a good investment. Sometimes you can actually lose money. I mean, you see how cheap oil's been the last couple of years. A lot of these oil and gas partnerships are losing money. So other than the tax savings, I don't recommend it. But it is an alternative investment if you can afford to get in on it. And lastly, let's talk about natural resources. Now, this includes companies that invest in oil and gas, but it also includes water and stuff like that. Basically, natural resources. You can also put in like logging, fishing, precious metals. All that stuff kind of fits under the natural resources umbrella. Now, natural resources have been hit hard the last couple of years because of oil prices being so low. But everybody needs natural resources. So personally, I think that it's a good buying market for natural resources. But you may not make a return on that investment for several years. Oil's going to come back up, and everyone's going to need water. Everyone's going to need gold and silver and wood and fish and stuff like that. But if you're looking for year-over-year sustainable profits, no. I mean, it's going to go up and down like any market. The oil shale boom really just drove down the price of oil recently, but it's going to come back because demand is constant and it's growing, especially with the emerging markets. China, Brazil, India, so forth. Now, when thinking about alternatives, the main reason why alternatives are appealing is they can usually be the only places where money is being made in a flat economy. However, I personally recommend and I strongly encourage you to stop caring about the year-over-year growth. If your portfolio goes down a little bit one year, don't worry about it unless you need the money like that year. Unless you're retiring or planning to retire in the next 5 years, it doesn't matter if the economy goes down. It doesn't matter if we're in a recession. You only lose money if you sell, and you only make money when you sell. So if you're not planning on selling, there's no reason to worry about where the economy is going that year, because you're not retiring that year. So for example, we had the housing collapse in 2009. Everybody freaked the fuck out, started pulling all their money out. Well, unless you're retiring in the next 5 to 10 years, why would you do that? If you just left your money in the stock market, it would have completely recovered by 2012. You would have lost nothing. It's only if you sold during the panic and then tried to buy after the market had completely recovered that you were basically bankrupt. And you have no one but yourself to blame. You know, if you're in your 30s and you're decades from retirement, why the hell are you selling? Just leave it alone. It'll come back in a few years. In fact, if you have the money, buy more. Buy it while it's cheap. Buy it while it's on sale. And then when it comes back, you're going to double, triple your money. Now, if you're not already in a cash position, don't sell when the market's down in order to buy. You're just going to cancel out your bet. But if you have cash available, buy when it's low. Buying low and selling high is how you make money. The problem with most investors is they want to see year-over-year progress and growth. They don't like it when they lose money in 1 year, even if they're not even planning on selling. They see their portfolio go up, they see their portfolio go down, and they get really pissed off when it goes down. It doesn't matter. Like, the real value of your portfolio shouldn't matter day to day unless you're going to cash out. If you're not planning on cashing out, it shouldn't matter. If you chart the day you buy, and then you chart the day you sold, that's all that matters. If it's higher when you sell, you made money. If it's lower when you sell, you lose money. All the ups and downs in between don't matter. But a lot of people are flocking to alternative investments because they're hoping that they can get a return in a flat economy. But the problem is a lot of these alternatives have very high management fees. So, investment advisors are all about selling them to you. But at the end of the day, are you really making money, or would you be better off just leaving it in stocks? And that's the main reason why I hesitated making this video. I want you to understand alternative investments because I don't want you to be glamored by them. Some of these jackasses think that they're so smart with their sophisticated investments when really they're just throwing their money at some financial advisor who isn't really providing any value add. So just be smart about it. And if your goals haven't changed and your retirement window hasn't changed, you really shouldn't be doing anything crazy with your investments regardless of what the economy does. Now, if you're worried about a financial collapse, well, your shit's gone anyway. You can forget about retirement. But we've already covered that in my video about gold and silver, so I'm not going to repeat that here. Assuming that the collapse is decades, maybe even a generation or two away, you owe it to yourself to save and invest for your future, so you can retire and die in dignity. You don't want to be sucking dicks at 60 years old. Anyway, to recap, I don't like hedge funds. They don't tend to be worth the cost. I like private REITs. I like limited partnerships better, but there's a higher minimum investment requirement. And I think natural resources have taken a hit recently, but I think it's a good buying opportunity if you're in that market. But also keep in mind you have to have a longer perspective. I wouldn't expect natural resource to turn around this year or next year, but just think 20, 30 years from now, do you think the price of petroleum is going to be higher? Do you think water is going to be more valuable? Fish and wood and gold and silver are going to be more valuable in the future? I think so. So this may be like a once in a generation opportunity with, the shale oil fracking thing, with oil being at an all-time low. Well, not an all-time low, but fairly low in living memory. Invest while it's low and then enjoy the rewards as it goes up. So anyway, I hope I didn't overwhelm you. I know I didn't go into the greatest detail into these alternative investments, and I did that because I don't recommend most of them, and even the ones I do recommend, 99.9% of you aren't qualified to invest in anyway. I did this just so you kind of have a little bit more understanding of these investments, and if somebody kind of pitches them to you and tries to wow you with their sophistication, you can kind of understand what they're talking about. You can understand the pros and cons of these different alternative investments. So anyway, if you have any questions or comments or concerns, just let me know in the comments section. I'll try to answer them. This is Turd Flinging Monkey. Thank you for watching, and I'll see you next time.